This is the story of one such time, a period of profound and universal uncertainty when the entire world held its breath, and the floor of the New York Stock Exchange became a chaotic theater of hope and fear. It is the story of the summer of 1914, the days leading up to the outbreak of the Great War, and the unprecedented and unthinkable event it precipitated, the complete shutdown of the exchange. The events of that time provided one of the most profound and lasting lessons in the education of a master speculator. It was a lesson in the supreme folly of betting on the unknown, and a powerful vindication of the one true principle that must guide all professional market operators. A man must trade not on what he thinks the news will be, but on what the market itself is actually doing. Jesse Livermore, through this period, was a dispassionate observer, a scientist watching a great and dangerous experiment unfold. He saw the amateur and the hopeful gambler being consumed by their own emotional reactions to the daily headlines, and he solidified the core of his operational philosophy. The principles he applied during this time of crisis are not historical curiosities. They are timeless laws of speculation. They were chronicled with brilliant and insightful detail by Edwin Lefèvre in his definitive work on the mind of a master. A link to that book, Reminiscences of a Stock Operator, now with a unique, detailed chapter-by-chapter analysis from Max Davidson, is left in the description below this video. This analysis is specially designed to make the timeless wisdom of the book accessible and powerfully relevant to the modern reader. Let us now set the scene. The summer of 1914 was a time of intense and feverish anxiety on Wall Street. The air was thick with the smoke of war rumors emanating from Europe. Every day brought a fresh wave of contradictory and often deliberately misleading headlines. One day the newspapers would declare that a peaceful diplomatic solution to the crisis was at hand. The market would roar upward on a wave of relief buying. The next day, a new cablegram would arrive, speaking of mobilization and ultimatums, and the market would plunge in a panic of liquidating. The floor of the exchange was no longer a place of business. It was a gambling den, a place of wild and irrational mood swings. The minds of the traders were not on the facts of the tape, but on the telegraphed whispers from the foreign offices of Berlin, London, and Paris. This is the first great folly of the amateur speculator. He attempts to trade on the news. He believes that if he can just get the news before the other fellow, he can make a fortune. He does not understand that by the time the news is printed in a newspaper, it is already too late. The market has already discounted it. The men who were trading in 1914 were not speculating on the market. They were gambling on the outcome of the greatest political crisis in a generation. They were betting on what-ifs. If there is a war, I should sell. If peace is declared, I should buy. Their actions were not based on a reasoned analysis of the market's own behavior, but on a hopeful or fearful guess about the future actions of politicians and generals. They had abandoned the science of tape reading and had become mere fortune tellers. The result was inevitable. They were whipsawed mercilessly. They would buy on a peace rumor at the top of a rally, only to be forced to sell in a panic on a war rumor at the bottom of the subsequent break. They were consistently and perfectly wrong. Their capital, the lifeblood of their business, was being steadily and surely depleted by this series of emotional, news-driven trades. They were acting like a man who has a tip on a horse race, a man who is certain he has a secret when in fact he knows nothing at all. What then was the position of the professional, the scientific speculator, during this period of extreme chaos and uncertainty? Livermore's approach was a model of cold, professional discipline. He was not trying to guess the outcome of the European crisis. He knew that was a fool's errand. His business was not to be a political analyst or a diplomatic expert. His business was to be a speculator, and a speculator deals only in the probabilities as they are expressed by the market's own action. He turned his attention away from the confusing and contradictory headlines and focused it on the one true and honest source of information, the ticker tape. He asked himself not, will there be a war? But, what is the tape telling me? And the tape at that moment was telling him nothing clear at all. It was telling a story of profound and violent indecision. There was no established, definite trend. The line of least resistance was not pointing clearly up, nor was it pointing clearly down. It was a market of chaotic, day-to-day fluctuations. In such a market that has no clear opinion, the wise speculator has no business having one either. The correct position, the most profitable and the most intelligent position of all, was no position at all. The correct position was to be in cash. And so, for the most part, Livermore stood aside. He watched the game from the sidelines, preserving his capital, keeping his mind clear and objective, and waiting with the patience of a master for the market itself to give him a definite and unambiguous signal. He understood the great central truth of speculation. A man does not need to be in the market at all times. There are times to be long, there are times to be short, and there are long, quiet times when the correct thing to do is to go fishing. The summer of 1914 was a time for fishing. This brings us to the core of his lesson from this period. The speculator's job is not to know the news before it is known. That is the business of the insider or the spy. The speculator's job is to recognize the trend, and the trend always precedes the news. The ticker tape is the true prophet. The collective wisdom, the hopes and the fears of all the men who are truly in the know, the great bankers, the insiders, the men with connections to the governments, all of their buying and selling is registered day by day on the tape. If war was truly coming, if the great financial powers of Europe believed that war was inevitable, this belief would be reflected in their actions. They would be selling their securities, repatriating their capital. This selling, this great wave of liquidation would create a definite downward trend on the tape long before the first shot was ever fired. The speculator who can read the language of the tape does not need to read the newspapers. The tape is the true and final source of all inside information. It tells the whole story to the man who knows how to listen. To trade on a rumor is to trade on a ghost. To trade on the confirmed action of the ticker tape is to trade on a solid, verifiable fact. The amateur is a chaser of ghosts. The professional is a student of facts. As the crisis in Europe deepened, the selling pressure from abroad became immense. The London Stock Exchange, the financial center of the world, was closed. Foreign holders of American securities began to dump their shares on the New York market to raise cash. The selling was relentless. The governors of the New York Stock Exchange, faced with this unprecedented wave of liquidation and the imminent outbreak of a world war, made a decision that was, at the time, almost unthinkable. On the morning of July 31st, 1914, they did not open the exchange for business. The great game was suspended. The machinery of Wall Street ground to a halt. The ticker tapes, for the first time in a generation, fell silent. The shock and the panic that this event caused is difficult to imagine. The speculator, by the very nature of his profession, operates in a world of constant motion, of liquidity, of the ability to enter or exit a position at any moment. The closure of the exchange was the equivalent of the laws of physics being suspended. Now, one must consider the fate of the men who had been gambling on the news. The man who had been heavily long betting on a peaceful resolution was now trapped. He could not sell his holdings. He was locked into a position that, when the market eventually reopened, would be worth a fraction of its former value. He was ruined. But the man who had been heavily short, the man who had correctly guessed that war was coming, was also in a perilous position. While he had a massive paper profit, he could not realize it. And in the meantime, his own brokerage firm and the entire financial system was at risk of collapse. He could be right on the market and still be wiped out by the failure of his broker. The closure of the exchange was the ultimate unforeseen event. It was the one contingency that no one had factored into their speculative plans. It was a lesson in the market's capacity to do the one thing that no one expects. It was the final and most brutal vindication of Livermore's patient and cautious stance. By having stood aside, by being largely in cash, he was immune to the catastrophe. His capital was not trapped in unsaleable long positions. His mind was not tormented by the uncertainty of a large and unrealizable short position. His capital was safe, and his mind was clear. His decision to remain inactive during the period of uncertainty had been the most profitable decision he could have possibly made. He had made money by not losing it, which is often the wisest and most difficult form of profit. This event solidified one of his most important principles. In the absence of a clear, definite, and powerful trend, the safest and most intelligent position for a speculator is the cash position. To be in cash is to be a king, ready to act with a clear mind when the fog of uncertainty finally lifts, and lift it did. The exchange remained closed for more than 4 months. When it finally reopened in December of 1914, it was a completely different world. The war was no longer a rumor. It was a grim and established reality. The initial uncertainty had been replaced by a new kind of certainty. The war, it was now clear, would create an immense and unprecedented demand for American goods, for steel, for copper, for munitions, for shipping. A new and powerful war boom was being born. A new primary trend, a great bull market, was beginning. The line of least resistance was now clearly and unmistakably upward. The conditions were no longer confused and treacherous. They were clear and pregnant with opportunity. Livermore, with his capital fully intact and his mind free from the emotional wreckage of the shutdown, was perfectly positioned to diagnose this new market and to act upon it. He saw the new leaders emerge. He waited for his pivotal points. And he began to build the great long positions that would become the foundation of his next great fortune. The gamblers, the men who had been wiped out by the shutdown, the men who had bet on the headlines and the rumors, could only watch from the sidelines. They had lost their capital and therefore their chance to participate in one of the greatest bull markets in history. It is in this moment of calculating risk and managing exposure, especially during times of great uncertainty, that the true work of a speculator is done. The emotional desire to gamble on a guess is a powerful enemy. It is for this reason that a constant study of these sound principles is a necessity for survival. A return to this channel, to this video and others, especially after a series of losses born of guessing at the news, serves to recalibrate the mind to the professional's scientific approach. The timeless and immutable lesson of the 1914 shutdown is this: a speculator must never, under any circumstances, bet on what-ifs. He must not trade on his hopes for a diplomatic solution or his fears of a military conflict. His business is not with the world of politics and rumor. His business is with the world of prices and volume. He must trade only on the facts as they are registered day by day on the ticker tape. The tape anticipates and discounts all future events. It is the collective judgment of all the best minds in the world, the men who are truly in a position to know. The speculator does not need to know why the insiders are buying or selling. He only needs to see that they are. The man who learns to ignore the deafening and deceptive noise of the world's headlines and to listen instead to the quiet, clear, and honest voice of the market itself is the man who will survive. He will prosper through panics, through booms, and even through the unthinkable event of the game itself being suspended. For his philosophy is not based on guessing the future, but on reacting intelligently to the present. And the present is always and only on the tape.